Hey traders, here is our monthly and year-to-date performance for our absolutely phenomenal asymmetric trade management passive asset allocation model. So once again, we are looking at our year-to-date performance and our monthly performance through the month of June. We're already at July 24th, so we'll have another update for you here shortly. This has just been such a wonderful place to put our money over the last few years as we have rolled this out. It's been a huge addition to what we do in our portfolio. Again, the genesis of the ATM program, or the asymmetric trade management approach, is twofold. Try to beat the S&P 500 on a year-in, year-out basis. Try to do it at less risk. We measure risk via volatility or standard deviation. It's a great program. It works with IRAs. It works with retirement accounts. We've got four main strategies that we work on. We look at short positions. It is sort of like a hedge fund. That's how we get the lower volatility, is that we have short positions that we cash flow as well as long positions. We use credit strangles to initiate or enter those positions. And then we use anchor positions from time to time that are directional in nature. Leap covered rights, sometimes they're referred to as a poor man's covered call or a poor man's covered put. We use all kinds of non-equity correlated items. We trade crypto, nat gas, oil, silver, bond, copper, coil, uranium, lithium, coffee. And we trade not only the US indices, but we trade all of the other ones out there as well. We are focused right now on China as a non-equity correlation to the US equities markets. Performance update, I'm still pretty darn happy with it. I don't know if it's still amazing or not, but I'm pretty darn happy with it. And I'm going to show you why I think we are still on track for an amazing result for this year. If you look at our performance update, 2021 was obviously a great year. 2022 was obviously a great year. Here's where we're at year to date through June, the end of June. Okay, you can see that in June we are overall we're up 10.78%. I don't know if you can quite make that out or see that. We're up 10.78%. versus the S&P, which is up 15.2%. So you can see that sort of tracked over here. Our number is in blue. The stock market, the S&P 500, is in orange. We've been doing a pretty darn good job this year of trying to stay ahead of the marketplace. And the end of May, the start of June was a little tough for us. We finished June very, very strong. We're off to a good start this year, or excuse me, this month, the month of July. So I want to talk a little bit about why I feel pretty good. You never know for sure, right? But why I feel pretty good that we are going to not only have a great year, and I'm shooting for 30+% ROI on our account this year, which I would be thrilled with. But why I also think we have a pretty decent shot at beating the overall market. Now let's take the easy one first, and that's beating the overall market. The S&P is up 15% halfway through the year. Annualize that out, that's about 30%. Looking at the headwinds that we have in the economy, I just, if I had to place a bet, I've got to place a bet that the second half of this year is not going to be as productive as the first half. Now, we're right in the smack dab start of a whole new earnings season. And I think that's going to give us a lot of transparency in terms of how companies are reporting and how they're acting. But we've already seen, namely Netflix, namely Tesla, we've already seen a couple of these big tech numbers come out. Market wasn't impressed with them. So Number one, I just feel like it's going to be a tough go for the market to perform as well in the second half as it did in the first half. Certainly could, right? But I just don't think that we're going to finish up 30+% on the S&P this year come December 31st. Number two, even though we are lagging behind the market a little bit right now, technically yes, but in my mind, no. And I want to show you quickly some of the metrics that I look at in our account and why I would say that. So let's jump into our account and take a look at it. So here's our account. Here's my account. This is my personal account. Started with about $23,000 2.5 years ago, and here's where we're at today. It's just been phenomenal. But this is our numbers right here, and specifically, I don't want to really get into our positions or talk about those. What I want to talk about is these numbers over here, delta, theta, extrinsic, and then looking at the maturity length tied to this extrinsic number, okay? So deltas, you'll notice that one of the things that we almost always have inside of our portfolio here, our asset allocation model, is a negative delta. Now, sometimes it's bigger than others, but we almost will always have a negative delta. What does that mean? Well, it means that this overall portfolio benefits. It makes money if the market goes down, okay? So again, dual fold mandate, beat the S&P 500 on a year in, year out basis, but number two, do it at less risk. We're designed to vastly outperform the market in bad times. Conversely, what does this also mean? Well, what it means is if the market does nothing but just go up, 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 we're going to underperform it. That's by design. That's by design. If you look at one of the positions that we took here, this is Siri. I got about $2,500 in it. We brought in $290 over basically a 2-week period of time. That's over a 100% return in 2 weeks. That's basically, if you annualize that out, that's a 200% return in a month. That's a 2,400%. That's a 2,000+% return potential annualized. That's great. We can take trades like that all the time. That's not what we're about here. If you want that kind of action, go to our live trading room. You know, this is just a $2,000 trade for me here. It's a very, very small trade that we're looking at. So asset allocation, diversification, non-equity correlation, all of that is very, very important for us in this portfolio. Here's what I look at. Number one, I want to have a little bit of a negative delta so that we can benefit from market downturns. Number two is theta. I have roughly about a $70,000 account here. I know that my money, my $70,000 here, is doing a good job for me. It's working hard if my daily theta amount is $300. So anything above $300 is a very, very good indication that I've got a good asset mix and that my money is working for me. You'll see on Friday expirations, as you roll into a Monday, your number drops because you don't have as much money at work, right? Because a lot of your positions have expired. So number one, I'm thrilled with this. I'm not even fully invested yet. I've still got $11,000 of cash here in the $67,000 account. We're going to put probably $5,000 or $6,000 of that back to work this morning. I'm fairly confident that I can get this number this week up over $360 a day of theta. That's fantastic for me. So that number, well above average. Generally, it's a challenge to get to 300, and we're already well above that, and we've still got a lot of cash to put to work. Last but not least, the extrinsic. So what does this mean? I've got almost $12,000 of extrinsic. Well, that is the profit potential of all of these trades put together. Okay, that's the amount of credit that we've sold that's out there, that's sitting there, that's waiting to be collected at expiration. So the two questions then are, A, what's the likelihood of that $12,000 moving from this extrinsic column here into my pocketbook, into my wallet, right? And I would say that that likelihood is 90+%. There's none of these trades that we have going on right now that I'm looking at and going, this one's gonna be iffy, or this one's gonna be a challenge. They all look solid to me. If I had the ability to change any of them, I wouldn't. That's how confident I am in them. So number one, yeah, I feel pretty darn confident that $12,000 is going to come into our account. Well, you add $12,000 on top of our $7,000 or $8,000, now you're up to almost $20,000 in earnings on an account that I started with this year at $63,000. That's assuming we don't do any other trades for the rest of the year. That in and of itself would put us above 30% return for the year, right? But that's the next question then. Part two is, great, you got $12,000 of extrinsic. When is it coming in? Are these maturities that go out 3 years? Because then, it's not quite as impressive, right? All of these maturities come in within the next 6 months. And I feel very confident on these. So, look, I'm going on the record right here. So we'll find out December 31st how close I am in my estimation. But I really feel like, well, let's put it this way: I would be surprised, frustrated, and a little disappointed if we didn't do better than 30% return year over year this year. And that would just add to another stellar year, wonderful track record that we have. And number two, I think we've got a decent shot at beating the overall market this year as well. So let's go back to our conversation that we were having before we looked at the positions that we've got going on right now. So this is where we're at so far, halfway through the year. I'm pretty darn happy with it. It's interesting. The rule of 72 says if you can make 2% a month, 24% a year, your account doubles every 3 years. You only need to double $2,000 9 times to turn it into $1 million. The idea that we are on track right now to double our account value every 3 years, and we're kind of disappointed with it, that's how spoiled we've gotten in this program. But I do feel really, really good that we will have a decent shot here at pushing higher. While I think the market's going to have a pretty tough go of pushing higher, I think we can catch back up again. But that's our overview for the month of June and coincidentally the first half of the year. If you would like to come participate in our live trading room, doing zero DTEs, things like that, you can go to tradelivewithus.com. But if you are more of an investor-minded, passive-minded, risk-focused person, someone that doesn't have a lot of time, someone that only wants to take 5 minutes a day and then they're done, well, that's probably the ATM program. It is investing. It's not trading. And you can go to tryatmforfree.com. You got 2 weeks to come in, have a Zoom session with me, talk about whether or not this is an appropriate strategy for you. I'd encourage you to take advantage of that. It has been absolutely a phenomenal program. Again, we've been through everything now in the few short years that we've had this program up and running. We've been through some incredible bull markets, i.e. this year. We've been through a bear market last year. We've been through a flat market. So we've been through every scenario. In every single situation, our results have not been good. They've been stellar. I'm going to say they've been stellar. They've been really, really impressive. So just absolutely thrilled with this approach. Again, if we can help you with this, I feel like this can be a life-changing approach. I really am targeting $1 million valuation on this account. Now, you never know for sure what's going to happen in the future. There's no guarantees. We always make that very crystal clear. But $70,000 principal, which is about where I'm at in this account right now, not adding any money to it on a yearly basis, letting it grow for 10 years at a 30% annualized rate of return. Future value, pretty darn close to $1 million. Pretty darn close. I'm excited about this program. I don't, as I've said many times, intend to touch this money. I hopefully will not need it in my old age, and I'm just going to let it grow, let that $1 million pass on to my kids, create some generational wealth. So if, again, you are interested in a passive investment program that is focused on decent returns, but more importantly, risk management, check out the ATM program. Go to tryatmforfree.com. You can set up a Zoom session with me one-on-one. We can chat about how to best implement this into your life. Appreciate you guys, and we will check back in with you here very, very shortly. It's July 24th already. We're almost through the month of July. We'll check back with you in just a few weeks on this month's performance results. Take care.